Well, accrual accounting is done, okay? But like there are some accounting entries that although we have discussed during our modules, but now I'm putting all those accounting entries in one module for your ease, okay? So in this module, we will be learning the adjusting entries and closing entries. Well, so adjusting entries, when we say adjusting entries, it means that we are dealing with some conditions. And this condition is for opening expense due. Opening expense due means that it is our expense that belongs to the previous year, but that was paid during the year. So since based on its payment it was debited to the expense account, now we have to credit this expense account and debit the opening payable thing. That account will be closed and expense will be reduced with this. For closing expense due, this is the expense for our current reporting period. That's why expense will be debited, and since it is not yet paid, therefore it is leaving a liability on us. So that liability account, expense payable account, will be credited. Liability increase means liability is to be credited. When we say opening advance payment, opening advance payment means it was paid in the previous year, but it is an expense for the current year. Therefore, it will be debited and advance payment will now be credited. It was an asset in the previous balance sheet, and now that asset will be transferred to the expense for the current year. So asset credit and expense debit. For closing advance, it was paid during the year as an expense, but now we have to reduce this expense by giving credit to it and debit advance payment, and this advance payment will become our asset now. Well, opening income due. This was our income for the previous year, but since it was received during the year, so it was taken to our income account. Now we are closing this income or reducing this income by giving debit to income account and credit to income receivable account. That receivable account will be closed now. And for closing income due, this is the income for the current period for which we have not yet received cash, since it is receivable. So debit income receivable and credit income account. This income account will be credited since it will increase our incomes for the year. And opening advance received. So this opening advance received was our liability that has now been transferred to our income. Liability will be reduced by giving debit and income will be increased by giving credit. And for closing advance received, this closing advance receipt is in fact not our income. This should be taken to our liability. So not our income means income should be reduced and our liability should be increased with this unearned income account. So let's discuss closing entries now. Closing entries, you know very well, these are passed for closing the income and expense accounts into the profit and loss account or income statement, whatsoever we call it. Remember, the tip over here is that when we are going to close an income account, that income account will be debited. Obviously, the income statement or profit and loss account will be credited. And when we are going to close an expense account, the expense account will be credited, and obviously it will be taken to the income statement by giving debit to the income statement or profit and loss account. Let's see what happens. For expense, income statement debit and expense credit. It is being closed. Any expense head, it will be closed to the income statement, always remember. And any income head, it will also be closed to the income statement. Remember this thing. So by giving debit to income, income is credit in nature. And when we have to close it, we have to debit it. So debit income account and credit income statement. So this income statement now behaves like a ledger account. When we are giving debit or credit over here, it becomes a ledger account sort of thing. So this income statement or profit or loss account, yes, consists of incomes and expenses. So all incomes and expenses are closed into the income statement or profit and loss account. Well, the important tips to remember over here are that adjusting entries are passed on reporting or closing date at the end of the reporting period in order to complete the incomes or expenses. We are completing the measurement of the incomes or expenses through these adjusting entries with respect to the accruals and prepayments concept. Okay, here accruals and prepayments concept is to adjust your incomes and expenses with their due or advance or prepayment or unearned things. And closing entries are passed on reporting or closing date. Both are passed on the closing date or reporting date, by the way, in order to close final balances of the income and expenses account into the income statement for the reporting period to which they relate. Okay, so thank you very much and be happy and relax. Now you are done with your accrual concept, which is normally considered as a difficult topic. Thank you.